In my view, we left part of the best discussion to last because I think regulation is incredibly important. It's my own, and here's my confession, my own preference in this in terms of topic discussion. I regard myself as a regulation wonk, not necessarily in this field, but I think we underrate the value of regulation. And you heard in the last session how regulators don't support innovation and that regulation is our best hope. You heard how providers will find all kinds of incentives to escape or find their way around the regulations, and you heard the desire of governments to strive to get the incentives right through regulation. And while we can take regulation to be a very broad set of instruments that would include self-regulation as well, in this session we're going to focus on the role of governments in rulemaking. We'll have a commentary by Stefan and Kate, and then we're going to open it to questions and discussion, and that's the town hall part. So,
thank you. So let me start by positioning this debate in the context of the book. We have heard from Jana in the morning about the core and the supply and demand being in the core and the supporting functions and rules outside. So that's page 27 of the book. I've also done my homework. So these are key elements of the financial ecosystem. And we have infrastructure, information, capacity building functions. All this is in the outer ring around the core. In this session, however, we will focus, as Susan mentioned, we will focus on regulation and the role of government, which is only part of that. But simply in terms of what we can cover within 45 minutes, we thought let's focus on those. And I will start by talking about the roles of government, and Kate will say something about regulation and the role of regulation. I believe the most important roles are probably not those you would easily think of because they are outside the narrow domain of financial regulation. So it's about guaranteeing the rights and freedoms of citizens. It's about enforcing the rule of law. It's about physical safety of citizens. All this is very important if you think about crisis countries and trying to actually promote financial inclusion in those. Even in the narrower financial sector domain, you have some things which are outside regulation, like maintaining macroeconomic stability, which is extremely important for financial inclusion. Everybody who has ever tried to promote financial inclusion in a hyperinflation country knows what I'm talking about. But in the narrower financial sector, I want to distinguish 7 potential roles of government. Some of them I agree with, others I'm not too convinced about. So there is infrastructure. There is the physical infrastructure, which is again outside financial sector, but there's also the infrastructure, the payment infrastructure, that's very important. When we talk about technology, it's a lot about that. So in case we haven't, so I'm talking about payment infrastructure like real-time gross settlement systems, payment switches, automatic clearing houses, and the like. There are also credit registries, which are often provided by government. In some cases, it's also private credit bureaus, but we heard about the example of, was it Chile or Peru? Bob mentioned earlier. The second role could be in government-to-person payments. It was briefly mentioned in one of the earlier sessions. So if you think about mobile banking models, branchless banking models, then G2P payments can often be very important to actually provide the necessary volumes and make these models profitable. So government can play a strong role by saying, okay, I use technology-enabled models to provide my government payments. The third role could be in financial literacy and capability. Ruth briefly talked about that earlier today. So this often has a public good character and a potential role for the government to play in that. Some other roles are the direct government provision of financial services, and this is like the past. We had that a lot in the earliest stages of financial sector development, and I believe there's a broad consensus now that better not. Another role could be to provision of subsidies, and this is what is often coming up when you discuss with governments about how to promote financial inclusion. So do we need subsidies, and if so, how do we spend them? This, to be honest, is a very broad topic, so I think it's too broad to cover here, and I can say a few more words about that if that is of interest during the discussion. And finally, there could be mandates, government mandates, which could be, for example, quotas of how much of your loan portfolio you have to spend in certain sectors. That's a quite well-known example of India, priority sector lending quotas. This is a case which is also hotly debated, and if you look at India, it hasn't been very successful in India. But I want to leave that for the discussion if we have time. I just wanted to flag this as another potential role for the government in financial inclusion. Thank you.
So you laid out a range of ways in which government may be involved, some of which are more regulatory and some of which are other kinds of instruments. Okay, do you want to take up the regulation discussion?
Sure.
More detail.
So I'll try not to be too wonky, but wonky enough for you, Susan. So I just want to say first, what is regulation? What are we talking about when we use that term? Because there's a technical term in some countries. What I'm going to use the term for is laws, regulatory issuances by regulators, and other rules that are adopted by government agencies, government bodies. And I also, when I talk about regulation, I mean, I'm going implicitly talking also about supervision. So that's very basic background. And what kind of regulation and supervision is relevant to financial inclusion? Well, it's quite broad now, and it covers all the different kinds of providers and also consumer-related issues. So you would think of the banking supervisor, of the financial intelligence agency or unit that covers money laundering, the consumer protection agency, maybe the telecom regulator, maybe the cooperative regulator. It can be a really broad range of people with their own agencies with their own standards and their own enforcement. So many people, when you talk to providers and others, will say that the main barrier to financial inclusion is regulation. Not everybody agrees with that, but many people will say that's the main barrier. Either the requirements are overly burdensome to consumers or to providers, or they're overly complex, or they just don't permit people to do certain things. Some countries don't permit banks to use agents. Others say agents have to be individuals. Other countries say agents cannot be individuals. So there's also a wide range of approaches taken in different countries, which can make coordination and peer-to-peer learning among regulators difficult. But aside from being a burdensome thing, regulation can also be very important in terms of creating an enabling environment, permitting institutions to do different things, creating incentives to provide certain products or serve people. Sometimes there are requirements under regulation. You must set up a certain number of simplified bank accounts for poor people, et cetera. The critical elements for creating what I would say is an effective and enabling environment, regulatory environment, are predictability, so that providers and consumers know this is the environment that we're dealing with, and it's not going to change from year to year. You know, things hopefully will evolve in response to the way a market evolves, but it's not arbitrary, and there will be input from the various stakeholders. Fairness, so that you have a level playing field, so you don't have one kind of provider getting certain tax deductions and another provider not, unless it has a basis, such as an NGO providing a public benefit, so you're entitled to certain tax deductions that a bank would not be entitled to. That there's effective enforcement, which we know is a big problem everywhere, right? Just having regulators and supervisors and enforcers who understand and who can actually enforce and are willing to enforce, sometimes going up against strong private interests. And then a key component of regulation that's really starting to become interesting and important globally when trying to address financial inclusion is something I mentioned earlier, which is proportionality. That regulators understand how to draft regulations that are proportionate, that don't impose burdens beyond what need to be imposed, that they understand what the risks are of offering certain services, that they understand the risks of certain institutions engaging in practices, like a microfinance institution, that should it or should it not be engaged in foreign exchange trading or other derivative products, things like that, that you have a regulator who understands this proportionality concept. And this is something that is new, and there's a lot of guidance that's coming out of the global standard-setting bodies in Basel, and then and they set standards for supervisors in insurance, in deposit insurance, in payment systems, and in banks, as well as standards for money laundering and combating financing of terrorism. These are 5 of the big global standard-setting bodies that are adopting this proportionality approach. And then the final thing in terms of creating an effective and enabling environment that I would list is just responsiveness to market pressures, so that regulators are constantly aware of how their regulations and how their actions are impacting the market, and where is the market going. And as Steve mentioned earlier, in Kenya, M-Pesa went forward in the absence of regulation. In other places, they might experiment with one thing or another, experiment with agent banking and see how that works, and then maybe modify. So I think this point, though, about letting markets sometimes act in the absence of regulation it points out the importance of the particular situation of each market, of each country, their economic situation, the legal framework. Is it a civil law, common law? And who are the providers that are involved? Because in the example of M-Pesa, you of course had very big, important players, Vodafone, and then the government of Kenya, who were shareholders in a company that was allowed to take off in the absence of a regulatory framework. So those are my opening comments.
We will open it to your comments and suggestions, but I can't resist one question to start, which is, in a field where you have potentially multiple levels of regulators and a broad field of regulators where in the interest of regulating something else, you're affecting or infringing or having an impact in this area. And we see in debates about regulation worldwide in many fields, the quest for smarter, better, it's called a whole variety of different things, regulation, where we try to coordinate levels vertically and we try to coordinate across. You don't need to answer it now, but I want to put on the table, is that an issue in that field, in this field, for the need for more coordinated regulation among governments or levels of government?
Do you want to answer now? Stefan, you want me to answer? You want to go ahead?
Yeah, I can. I think one good example is probably in the area of anti-money laundering, because this is an issue for many countries which goes far beyond the issue of financial inclusion. It's on the top of the agenda for many financial regulators because they don't want to be blacklisted, and it's very important also for the reputation of the financial sector internationally. And then there's financial inclusion, which is like might be a small agenda compared to this broader agenda for the government, and it has huge implications. The regulations on anti-money laundering can have huge implications on financial inclusion, on access, because they prescribe know your customer rules, which are very hard to comply with for poor people. That's the main problem with them. So I think in such a case, we have realized in our work it's very hard to argue, because you obviously have your own agenda, you want to promote financial inclusion, but you realize, and you also understand that that's a bigger issue where you have to understand the broader picture.
There's a question back there.
Chris Eaton. Beyond the fostering of an enabling environment, which might be different things in different contexts, I'm wondering about, are there good examples of government policies to promote financial inclusion, quotas, for example? Or are these kinds of policies always distortive in a negative sense towards the achievement of financial inclusion? And I guess I'm wondering whether those kinds of policies, whether they are more important, less important, complementary to other drivers of, potential drivers of financial inclusion, such as good financial education or technology and technological development, or the fostering of competition, which of course relates to the enabling environment that is established. Is that clear?
Yeah.
Okay.
It's not completely clear to me, so I'm wondering what you mean by policies, because this is a very wide.
Absolutely. So I guess beyond the sense of just an enabling environment, which of course is a series of policies, but more targeted things that government does that places requirements on financial institutions to reach down to the poor. Things such as quotas in India. So you have some of those negative things, or you have some of those kinds of requirements. On the other side, there might also be incentives that the government might put in place that induce changes in the behavior of financial institutions that reach down. So there's two sorts there. Do we have any good evidence regarding the efficacy of different kinds of policies like this for fostering financial inclusion? Or are they always distortive? Do they always distort in ways that are unhelpful? And I don't know. And then how those sets of policies versus other kinds of drivers for financial inclusion. How important are those policies versus other things that help us to achieve that goal?
So maybe I'll start and then you can continue. So I think that there have been a lot of failures with these government programs where they impose obligations to make loans to a certain group or category or geographic location, or they require certain accounts to be opened. And I think one of the problems is usually that the measures are designed without input from the private sector. So policy measures that are thought up in the heads of the policymakers without an awareness of where are the providers, who are the providers, how big are they, what is their technology, what is their capacity, what can they do? I think that it's very hard for those things to succeed. You can't move forward, just by pushing on it, so that's. I think I'm trying to think of examples of where it has been successful, and nothing's coming to my head right now in terms of this. But maybe while you're talking, Stefan, I can.
It's a very popular debate in India because they use the government and the central bank often have used an approach of mandating certain quite specific issues. For example, these quotas, but also they have financial inclusion strategies where they ask banks to open certain outlets, which could either be branches or agents in certain geographies to cover the whole country. And there's one side which says we have to do that because otherwise the banks will never go there. So we have to push them. We have to actually force them to go into that. And once they are forced, they will think about the best solution and will actually achieve a lot. But then there are the others, and I tend to rather believe them, who say, whatever you do, you introduce a distortion into the market because you force private sector players to do something which they wouldn't have done on their own. So this is a loss-making proposition, and the banks, they might just write it off as a loss-making enterprise or loss-making entity in their group, and they might not use the best people to think about how best to comply with those requirements. But it's just cross-subsidization. In the end, you have some losses which occur in those unprofitable branches and outlets, which you have to cover through income in other areas.
Yeah, actually, there's so in South Africa, there's the Financial Sector Charter, which was something that was an agreement among the banks with pressure from the government. And they signed, and the banks undertook in this charter to set up in a certain period of time, among other things, they undertook to set up in a certain period of time something like 3 million simplified accounts that were called Mizanzi accounts. And they did this in the period of time. In fact, they set up more. And today, many of the accounts that were opened are now closed. And, but they were involved, first of all, in the initiative and in the design and in the scope of the undertaking. And even though many of the accounts that were set up are dormant, and it actually spawned other banks and other financial institutions to set up similar accounts with maybe slightly different provisions. So maybe the direct result, how many Mizanzi accounts are there today? How effective was that measure when you look at those accounts and how often they're being used? Maybe you would say, well, it wasn't as successful as we would have hoped, but when you look at it in the bigger picture, you see what it encouraged. But to me, the critical point of this was that the banks were right in there in the design of it. And are you shaking your head? You agree? Yeah. Thank you. Yeah.
Other questions? Yes, Steve.
Could I just add a comment to that? I mean, I think it is a very good point to say that I think when policy and even regulation is established without any reference to a dialogue with the private sector, it runs into problems. But I think one of the things we've seen over time is that a tool that tends to work, but not always, is where this is a constant dialogue over time, and adjustments are made over time. And there's a confidence in the dialogue between policymakers and private sector. And that's not been the case in most countries. And where we see it start to happen, you see these adjustments being made.
Right.
And you see this whole question of how does our incentive make a difference. You see regulators even using behavioral economics to understand the effect of what they're doing out there. And I think these are ways that we could improve on this, but we have a lot of failures because policies have been set in some office and they've been put in stone for 5 years and nobody talks to anyone else.
Thank you. Yes.
Steve Mason with Aga Khan Foundation, Canada. I'm interested in exploring a bit further the roles that government can play in consumer protection. I come from working in West Africa where government has set a fixed interest rate that MFIs can charge, or at least across Francophone West Africa, as one tool that they think is useful in protecting the consumer. But it has a lot of negative impacts, and MFIs have found many ways around that interest rate. So have we, or have you seen effective ways that government have set up consumer protection programs or policies, and how applicable would they be to other contexts?
So yeah, this interest rate cap first is something that different governments are trying and experimenting with and kind of asking for advice on. And to the most extent, when you look at caps, they've failed because either they're higher than what institutions would need to charge, but they go up. So they meet that threshold, or they're too low, and then the institutions pull out, or they start to charge fees and other things, and then you lose the transparency. So in every case that I've spent time studying, it's been a failure, and then you sometimes you actually lose the providers because they shut down, and then the consumers have to go informal, which isn't ideal in many situations. But there are the other consumer protection. I mean, transparency is a critical issue. I'd say transparency and clear statements so that consumers can understand. Like in the United States, we have the Schumer box, so you can look at a credit card, what it's offering. You can compare credit cards, what the terms are. That kind of like standardized plain language and enforcement, like proper enforcement. These are things that I think some of the issues that people are focusing on. And I mean, there are different international bodies that are setting forth these standards and are working in different venues with governments who then do peer-to-peer learning. I don't know if that answers your question.
Maybe just one addition to that. I think the principle of proportionality, which you mentioned at the beginning, is very important in that regard as well, because there's a risk that regulators jump on this opportunity to regulate consumer protection as something new for many of them, and say, okay, let's introduce the gold standard. Let's have very strict disclosure rules There must be consumer redress mechanisms in place for each single customer who has to, the provider has to come back within like 2 weeks with a clear explanation or response. That's probably hard to enforce and might also lead to more exclusion. So in many cases, I think you can start with very simple regimes, and disclosure is, I think, one which is very important so that people understand what they're getting into. And this has to be coupled with consumer education, because if you don't have educated customers, disclosure won't be very effective either.
Something that is happening right now is with this new technology and the data, the availability or accessibility of big data and the use of big data, meaning you gather a lot of data that's readily available and you synthesize, and then you kind of analyze who are our customers, what do they need, what do we think they need, and then you go out and you try to present that. Not just big data, but generally the use of technology has raised privacy issues, and now in the EU and in the United States and Canada, and I know Canada is on the forefront of what's called privacy by design, where there's an encouragement or there's requirements of providers to implement technology that includes privacy protections. But these issues are kind of right now on the forefront, and how do you protect consumers? How do you ensure that their personal data won't be misused? This is something that's being like tested in many countries, and in most countries in Africa and in Asia where I work, there is very little consumer protection at all. There may be a law, but there wouldn't necessarily be proper enforcement. And there's a lot of people are on hold right now as they're waiting to see what happens in the EU and the US, which direction those laws are going, because often in the EU, the laws are actually imposed on countries or on companies that send their data abroad. So if they're going to outsource, then the EU will impose on the company that's outsourcing the requirements on its outsourcer. So that means these countries are actually looking to the EU to see where their laws are going. But this is just an example of where laws and regulations are very much in flux, in large part due to the advances in technology.
Question back here, yeah?
Hi, Riaz from AKFC. As somebody that is just coming back from working with an MFI in northern Mozambique with our partner, the Aga Khan Agency for Microfinance, I think if we're talking about effective regulation, I think we also have to introduce a conversation, or a discussion at least, about compliance and how to ensure effective compliance, especially when in certain environments, a number of things that I've heard today is that if we're talking about financial inclusion, there are a number of actors are implicated in that discussion. And one of the things that I saw were MFIs, small MFIs, being regulated as full commercial banks, which poses a number of challenges for effective compliance and effective enforcement of regulations. So I just wanted to hear your thoughts on that.
Compliance is a big issue.
Yeah, it's certainly the worst case if you have very strict regulations and then you don't enforce them. I think the old saying is don't regulate what you can't supervise. So you have to think very hard what is the capacity of the regulator and what kind of regulations to impose, and also whether they are justified. If you say you have a case in northern Mozambique where you regulate MFIs like full-fledged commercial banks, that doesn't sound very proportional. And if you don't have the capacity to supervise and enforce, they won't care anyway. Why would they? It's, I think the challenge I see is that sometimes people argue if you don't have the capacity as regulator, you just don't permit it, which has negative implications for inclusion. So in the end, you can't get away from the fact that you have to build the capacity to look after these institutions, after smaller institutions, but also find ways to minimize the cost of supervising them based on the specific risk profile these institutions have. And if they have low risk, in practice, you go on site only every 2 or 3 years, and otherwise you get your reports in, which is much cheaper to do.
There's a question in front, yes.
Hi, Hi, I'm Isabella Valchiasson. My question is around, so looking at roles of government and regulation for financial inclusion for the poor, just want to add in this conversation, we've been talking about the poor as a homogenous group. So thinking about the thing is that not all citizens are equal, and thinking about those subgroups, how do we look at, for example, clusters of women, and do they have also access to financial institutions and services, or youth that are emerging as one of the largest populations and segment of populations in the world? So I guess my question is, are there regulations or affirmative actions that exist for certain segments of the poor population to access financial services? Are there successful examples? And we talked about India, about forcing quotas and the challenges with that without the conversation with the private sector. But what are the incentives for the private sector to enter to serve not only the poor population, but the marginalized within the poor population that don't even if they're making $2 a day, might not have access to use that $2.
So perhaps two questions there. One is that regulation can be quite a blunt instrument, and how do we specialize, customize, tailor it, and then the incentives for the private sector.
Right. So I guess one question is whether laws and informal rules are discriminatory vis-a-vis certain segments of the population, and that's and then. If there aren't discriminatory laws, and if the rules, usually the informal rules, there is discrimination of one sort or another in most places. But in terms of the laws, if there are anti-discrimination provisions that are enforced, but it's still not being addressed, there are still discrepancies. What do you do? And I think there is a big role right now that donors are taking in doing research, for instance, on what products do women use, how can they be better served, why aren't they being served in these places, and I'm kind of scrambling to think about other very concrete examples of things, but I know in the United States that banks that are insured by the Federal Deposit Insurance Corporation are required to lend in a way that's non-discriminatory, and they have to show that, and that is based on gender, race, nationality, age, and other things. But I've never done a study, and I've never done a study on what the laws are in a range of countries. I only know this because I've recently started some small research project to try to figure this out vis-a-vis women. Do you?
Yeah, I think the main point I would have made, you also said that it should be non-discriminatory on the regulation side. So I can't see that you have regulations which have like specific provisions in there which positively are like affirmative action with regard to certain groups of people. That's then a different question of different instruments, and it probably leads to the question of whether there could be any subsidies from the government side to make it more attractive for providers to go into to serve these groups. So you can think about tax incentives and outreach funds to for new product design, support institutions to design new products which better serve this market. But that's also like the typical instruments donors use in many of those cases.
Right. So if I can push that just a little bit, if we go back to the important question we had about demand and differentiating demand and really understanding the nature of demand, would you both argue that where we want in a positive way to discriminate, because we know that needs and demands are different among different segments of population or in different areas, that regulation would not be the way to do it? We need to look to other instruments? Is that a fair assessment?
Yeah.
Do either of you want to then tackle that was easy, yes.
Short answer.
Short answer. The question about incentives or ways of incentivizing the private sector, and how do we
I do think that, as I said, that the donors, that this is a role where it's, donors are playing this role right now, and I guess the question then is, well, are there other incentives, tax incentives or other government programs that could, that would fit into that well? And I would say it kind of dovetails with Chris Eaton's question before about government regulators' role in encouraging providers to do certain things. This is a slightly different issue because if there's a segment of the population that isn't being served, and there's a it's a systemic problem that's not being addressed by anyone, then maybe there would be some kind of just imposition. But as I said, in the United States, it's more of it's not an affirmative action requirement, but it's some, and I don't know how it's enforced right now, but you have to be lending to all the, you cannot discriminate whom you're lending to, whom you're serving, who your clients are. I don't know.
Other questions? Yes, back.
Becky, this is not a question, it's just a quick comment on the regulatory capacity question. I think there is a room for donors to work with the central bank and strengthen their capacity, because that is the government institution that is in charge of supervising the financial sector. So, which comprise microfinance institutions. So if there is no regulatory or enough regulatory capacities, I think donors can strengthen those capacity by working with the central bank, which must be in charge of the oil sector. Okay, thank you.
One last question here, and we need to wrap up.
Jennifer McDonald, Women's World Banking. We've been talking a lot about incentivizing financial institutions to go there. I'd like to take the discussion back, if we can, to the issue about enabling and legislation and regulation, and what are the key elements for changing the environment to support it more. So I've had the opportunity in the last year to take groups of motivated bankers or microfinance players to some of these key markets where agency banking or mobile banking models are very active, and then they become even more motivated about going back to their countries and doing it, and often they face the situation that there are gaps and that it doesn't really support them to do it. So just curious about what advice you would have for financial sector providers that are interested in moving into those areas when there's not already a good legislation or regulation in place to support it.
Yeah, I think you mentioned already what's very important is also for regulators to show them positive examples from other countries. I really believe in that concept of exchange visits for them to send them, which AFI, the Alliance for Financial Inclusion, is doing a lot, to send them to countries where they can see the positive examples of how it works in practice. Because regulators, as conservative as they typically are, they have to see that others have done it and that it works. And it's often. I think it also depends on how strong they feel about financial inclusion. So if you have a regulator, thinking of Pakistan, for example, which has the central bank in Pakistan is very much interested in financial inclusion, so they really drive the topic, then sooner or later they will realize, okay, we can't get anywhere with a brick and mortar model. So we have to think about agency banking. Otherwise, we will never reach this huge unmet or the huge unbanked population. And then it's easier to argue. But this varies a lot from country to country, obviously.
Yeah, and I think often when if you're doing this kind of peer-to-peer learning of regulators, it's helpful for regulators to go to places in their region where there may be more similarities in the legal structure and the economics and who the providers are. Sometimes going far out of the region, it just feels like, well, they don't have this, and they regulate that differently, and we don't have this. And so I think it's important to find the countries that there's already some kind of communication, whether they're in, like, for instance, East African community, and then those countries also, they work a lot together and learn from each other and share.
Well, thank you both. That discussion about peer-to-peer learning among regulators takes us nicely to what will be our next discussion of some of the peer-to-peer learning among donors.
Thank you.
Thank you.
Thank you.
Thank you.